We put up a chart earlier today, Steve Weissman did, showing consumer confidence not only for this year, but going back for the last 50 years, just sort of put in perspective what we're seeing in terms of that confidence level. How would you describe the drop we saw in December? Do you see this sort of as just a blip or coming off of these strong levels, given all the uncertainty and volatility right now? Or is this, I guess, a canary in the coal mine for what could be slower economic growth next year?
No, I think we're at very, very high levels historically, as Steve's data showed earlier. And what you see in this month-to-month comparison is just, a little bit here, a little bit there. The Consumer Confidence Index from the Conference Board is made up of a couple of sub-indices, and one of them is the Present Situations Index, which is very, very strong. In other words, when people say, how are they doing right now? The jobs market is very strong, wages are very strong, they feel very good about where they are. When you then start to say, well, do you think things are going to get better in the next 6 months? They say, well, no, they're not going to get a lot better because they're so good right now. So I think we're on this plateau economically, and I think things are not expected to get a lot better, but they're not expected to get worse from here as well.
David, do you agree with that in terms of where we're at economically right now in the U.S.?
Not really. I mean, the stock market has been so erratic in the last couple of weeks, and people say, well, it's because the Fed raised the interest rates a quarter point. I mean, you show me a CEO who says that people don't want to buy their product because the Fed interest rate went up by a quarter point. I don't think that's what's happening. I think what's happening is, first of all, for the first time since World War II, the independence of the Fed has been called into question. When you have a Treasury Secretary who has to make up a quote or a tweet by the president to reassure markets that the Fed will remain independent, that's destabilizing, especially when we have a political environment where monetary and fiscal policy is really used to get people elected or reelected. That's frightening. The second thing that's happening is that our trading relationships with our important trading partners are in trouble because we've got a situation where we poke them in the eye instead of saying, look, these trading agreements need to be revisited, but we need 2 signatures on the page at the end. So we need what's called an agreement. Lastly, we've had this infatuation with whatever the latest statistic is, unemployment, GDP growth, instead of thinking about the underpinnings of our economy, like our fiscal and monetary policy. And for there, we score very poorly. We have $22 trillion in debt. We passed a $1.5 trillion tax cut that was supposed to be paid for by spending cuts, didn't happen, and by GDP growth, didn't happen. I mean, we're about 3.5% GDP growth, and we're going another $1 trillion in the hole. And you know what? If I'm in debt personally or my company's in debt, you have one of 2 choices. You either go bankrupt because you can't ever pay it, or you have a plan to get out. And the problem is we don't even have a plan to get out of this debt mess that we're in. And in 2034, we're messed up.
Steve, the debt problem is a largely intractable one, but on the Fed independence and trade, I mean, those can be quickly reversed given the right set of policy choices.
That's right.
Yeah, that's
right. I'm sorry. Go ahead, Dave.
No, please.
From a consumer standpoint, you don't see that those issues show up. They're not worried about stock market volatility at the moment. That comes and goes. We're not seeing the issues with the trade show up in consumer confidence. And in fact, from a consumer standpoint, which makes up 70% of the economy, we're seeing at the highest levels of consumer spending with this great holiday season. Retail sales are up over 5%. Online sales are up nearly 20%. So these are very, very strong levels. You don't see this kind of slowdown. When we talk to our CEOs, they're worried about the trade, but that tends to be sector specific. When you talk to the aluminum people or the steel people, they're concerned about their issues. But overall, I think we're sitting here at very, very high levels, and I think that's what we have to keep in mind.
Well, Steve, consumers probably don't worry much about a company's stock going down very much, but the CEOs of those companies, they do, and perhaps with their borrowing costs going up as well. So I wonder if you think the markets can influence, let's say, things like 2019 investment spending by big companies in that environment.
Well, it certainly can. Volatility does that, and I think the question is, as was raised, where is the Fed going with this? And when the Fed made some dovish comments, you saw the stock market rally. They walked it back a little bit. It went down. I think this is what you're seeing. I think it's monetary policy more than anything from the perspective of CEOs. And that's important because their cost of capital is so directly affected by that. So I think we'll have to see, is it going to be 2 increases or 3 increases next year? Is it a quarter a point each? And I think, you know, you've got 2 baked in. The question is whether there's 3 or more.
David, going back to your earlier points about the Fed and you know, this argument around politicization of the Fed, you sound like somebody who doesn't think that President Trump and Fed Chair Jerome Powell should sit down for a meeting. Am I wrong here?
Well, I think it's perfectly fine for the president or the Treasury Secretary, which he does, to talk to the Fed. The question, though, is whether that impugns the independence of the Fed. That's the line that you can't cross. And the reason is that the Fed is the one institution that's worried about our long-term economic health. I think it's perfectly appropriate for the executive branch to talk to the Fed. But then the executive branch needs to make clear to the markets that the Fed is independent. Look, the Fed's independence is not based on sort of custom or courtesy. It's structural. The way the governor's terms are laid out, the open market committee, the way those discussions are kept in secret, are all because we want to take the Fed away from the political process. And that's important, and that was jittering the markets. That Donald Trump and the Treasury Secretary need to calm down.